Okay, testing, 1, 2, 3. Good morning. How's everyone doing? Boy, you're looking good. Wow. YJ wants 1, 2, 3. How about 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233. Yeah, you guys ready for another Forex trading session? Today is a Monday. So therefore, well, Monday the 25th of January, first day of school at Harvard. Pack your card and Harvard Yard. Cool. And then what? Beautiful trading week. We just came off of last week with key reversals in multiple markets. Really hoping we can get a trend out of things. If not, holy smoke. So very important week technically. Got a lot of things going on. Is Japan going to do more quantitative easing? Well, we'll find out, right? So lots of question marks, but lots of trend lines too, right? Lots of support and resistance in the market. So we got a lot to do technically. Because it's a Monday, we need to do commitment of traders report. So we're going to look at large positions held by institutional investors like hedge funds. We need to go through the calendar, look at event risk and opportunity for the week, squeeze in some technicals, right? Yeah, FOMC, so lots of very interesting stuff to talk about. So without further ado, get on with it! So welcome to Forex.Today. By the way, you know, a lot of real people put a lot of real effort into putting Forex.Today together for you, and since it's completely free, would you be a love and subscribe, register, share, chat, leave comments, you know, instead of just reading it, movingon.com. Would you do that? That'd be really cool. By the way, trading's risky, not appropriate for everyone. However, your past performance, good or bad, is not necessarily indicative of future results, so you should always try your best. Stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that gives traders access to Forex markets, but many other related markets as well, like stock indices and energies and metals and everything. The whole kit and caboodle is available there. I lead the strategy sessions every Monday through Thursday here at Forex.Today, starting at 7:30 in the morning New York time, which is London lunch. But every Friday at fxstreet.com. You're welcome to attend any of those. If you'd like to attend a live event and be able to chat with your fellow traders and to be able to interact with me while I do these events, and I encourage questions, and if you want me to cover particular pairs, I ask that you ask. So to do that, all you need to do is register at Forex.Today. Don't worry, it doesn't hurt. So without further ado, let's get into it. Let's play the happy music and then start the day. I'm so happy, looking for Forex trading ideas for today. Oh, there it is, Forex.Today. Boop-a-doo. All right, happy music. It always puts me in a good mood. Actually, I get grumpy when I'm not hanging with you. So you make me happy. You make me a complete person. The rest of the day, I'm just a grumpy old man. So thank you for being on my team, guys. All right, so yeah, okay. Let's go to Forex.Today. Here we are live. And we need to do the calendar. Beep. We'll start with that, eh? Lots of stuff going on. Let's filter the stuff out. And that's going to be a little too much, I think. Yeah, that's going to be too much. All right, well, we'll just go to the big ones. Boom. All right, let's start there. Let's hide that filter. Let's see. Inflation obviously is an important deal when it comes to currency trading, but there's other things going on that are more important, right? So Aussie is interesting because it's been stuck at 7.00000 against the US dollar for 6 months? 5 months maybe? And, you know, at one point, right? At one point, when do we declare that a bottom, right? So you can't really declare it a bottom until you have the fundamentals, but technically we've been moving sideways at 0.700 for a very long time. So I guess the real question is, you know, has it bottomed out? Is there inflation in the market? Well, they're actually looking at a decline quarter over quarter. You know, but is that the beginning of dropping us all the way down to 60? No, probably not. Well, would a good number here lead us to go up to 80? you know, I don't know. So what's going to break the range? So I don't think this is going to break the range, but you know, a really bad number might get Australia to talk about lowering interest rates, and the RBA. In particular, Governor Stevens is a master and a wizard at talking down the value of the currency without actually having to do anything. But, you know, I don't think we're going to see the end of the world stuff. But, you know, so a less than expected number is already expected. So I think the upside part of this would be better than expected. But I don't really see that. You know, where would that inflation come from? You know, oil prices falling over the quarter, you know. So I don't know. You know, much worse than expected. Probably get an Aussie dollar scalp, pick up 30 to 50 pips. Better than expected, maybe about the same. So I would, you know, I would venture to guess just on market sentiment that maybe it moves. But you know, you'd have to get less than 0.3 to get it to seriously move to the downside, and that would be seriously bad. So, you know, I don't know. Let's pay attention to that one. It's not as much of a call. It's just like, I don't expect something dramatic out of it, but if something dramatic came from it, then the market might move. But, you know, dramatic, right? So it's an interesting thing. Well, how about this? Let me back up. Economic data. There's two reasons why it's important. Hey, that's a good setup, isn't it? All right, economic data. There's two reasons why it's important. One, if it comes out unexpectedly, good or bad, you're going to get volatility and you can scalp that. Number two, if it leads a central bank to consider changing their policy, it'll move the market. So sometimes you get bad news that's good for a currency. Have you ever noticed that? And the reason it was good is the news was so bad. Well, what's that all about, Uncle Wayne? Well, it's so bad that people are trading the assumed response from the central bank. And they're already front running because it's so bad, they need to do something that will lead to something good and that kind of stuff, right? So, you know, just be careful, right? So we'll see. I don't expect unexpected to happen, and expected is already bad, right? So where's the real surprise going to come from? Negative inflation? Maybe. or, you know, the same as last quarter, maybe. I don't know. I think they're probably going to be spot on. 0.3 is probably going to good. Okay. This little thing about FOMC, we're going to learn a lot. No, I don't. I mean, you could go to the Fed funds rate. Well, why don't we do that now? Do you mind if I do this now? I never even thought about it, but we can just do it now. Oops. Fed funds rate. I mean, we could talk about it, or I could just show you, right? They're not giving me the hang on, Fed funds rate futures watch. That should probably do it. Trading. Do they change? They changed the link? Really? No. Well, we'll try it. Let's see. No, that's not it. Fed funds futures. Let's do it that way. Futures watch. Why can't I remember the URL for it? Futures watch. Sorry guys, I didn't think it would take this long. Quote what? I thought it was like cmegroup.com/fedwatch or something, isn't it? Fed funds futures. Why don't I just FedWatch? Hang on. Sorry. Oh, I need to look at, you guys got trading interest rates countdown. Why do they, so now that's the one I wasn't clicking on, but why would they do that one? Why did they change it to countdown to FOMC? Weird, whatever. It used to be just like FedWatch tool or something, right? So anyways, all right, so yeah, January. Probability of a rate hike, 12%. 11.9%. Yeah, not highest. Kenny translates. Right? Thanks, Kenny. What does this all mean, Basil? Kenny's quick on the job. Ciao. Yeah, Kenny's right. Yeah, that's not very high. And you may remember how this is all calculated, right?
Commentary from Greek Central Bank Chief Stornarnis saying he expects 0.2% contraction.
I mean, what is this, right? So look at 30% chance, 32% chance in the March meeting. Huh. So this comes down to actual price. One thing I like about this tool is it's not an opinion. The tools where they sit down and say, hey, trader, how do you feel? Do you think they're going to raise interest rates? Like, what a sissy tool those things are, right? Consumer confidence. How do you feel about being a consumer? Are you going to buy some stuff next month? Right? It's so stupid. This is money. Money's not stupid. Money's power. Right? This is actually how, this is a very liquid market. I mean, it's as liquid as Forex, right? I mean, by definition, it is liquidity. So, a perfectly efficient market based on money. So what we're looking at is the difference in price of these Fed funds futures, right? So the risk is the same whether you buy a January or a March or a November, right? The U.S. government's not going to default. So there's and it's all very short-term liquidity. Whether you're talking January, March, or April, you're able to get out of that if you need to, because you don't face like long-term risks like a 30-year bond where, oh wow, inflation could radically change in 30 years, right? Is inflation radically going to change between now and April? No. So there's not very much risk, right? But if the market thinks the Fed's going to change interest rates, then that would change the value of these bonds. So look at this. If you want to lend the government $100 today, you only have to give them $99.66. And then you get $100 back. Well, how about for March? So today you lend the U.S. government $100, and they're good, or you're actually on March 16th. The government's going to give you $100, but you only have to lend them $99.60 today. You only have to lend them $99.57 today, and on April 27th, the U.S. government will give you $100 back. You see? But why is there a difference in price? And that will come down to these market participants saying to you, or to each other really, that they think the Fed is either going to raise interest rates or not going to raise interest rates. It's a giant auction system. They're always right because it comes down to supply and demand. It's beautiful. Always comes down to supply and demand. Whether these market participants, and we're talking about something way bigger and way more liquid than the stock market. The stock market's stupid in comparison to this market. And this market gets together, billions and trillions of dollars worth of trading, right? And these guys get together and they say, well, we think the Fed's probably going to raise interest rates, but not until a certain time in the future. And you can figure it out by the difference in price, because risk is going to be so similar whether it's a March or an April, unless the Fed raises interest rates, right? So I really like this tool. It's pretty smart. It's very smart. Okay? And then you can use this tool to look at the difference between, a 3-month and a 1 year, or then you could look at things like the difference between a 2-year bond and a 10-year note, right? You could look at, how about in the United States, a 10-year T-note pays about 2%? What does it pay in Germany? What does it pay in New Zealand? And what does that all mean for supply and demand? Right? It's all very interesting stuff to a currency trader. Very, very interesting stuff to a currency trader. That's only money. Okay? So anyways, the market has not priced in a Fed rate increase. Now, one of the things that could happen is then maybe the dollar doesn't get strong for a while. You know what I'm talking about? Then RBA. What do you think about the RBA? Are they going to raise interest rates? I'm getting like 700 texts as I'm doing this. Hang on. Yeah. Oh, there we go. Hang on. Okay. So, the RBNZ is not likely to raise interest rates. It'd be very interesting if they cut interest rates, but it's not forecast to be that way. But let me outline something to you that I talked about last week. Now, you might recall Thursday and Friday, the New Zealand yen pair, the Kiwi yen pair, went up quite a bit. And there was a couple of problems with this. Now, it's hopeful because you want that particular pair to go up because the interest rate differential is so great, and that's a great carry trade. The problem is the fundamentals don't quite agree with it. So some of the things we talked about last week were things like the U.S. Department of Agriculture in the United States had predicted that dairy prices were going to fall another 6%. And that's a very bad thing for New Zealand. And there's been some other things that have pointed out that, you know, things are not, let's say, not likely to get very great or very good in New Zealand on the short run. So even though the Kiwi was up versus the yen, it was probably more yen than Kiwi, and who knows? It was one of these situations where you want it to go up. It's very easy to believe it's going to go up because you want it to go up, right? You guys read Friedrich Nietzsche? You big existentialist fan? Perception creates reality. Right? In terms of trading, we call it confirmation bias. You see what you want to see. Then you're like, Kiwi yen! It's woo! Man, you got to be careful, is all I'm saying, bro. Because what we need is the technicals and the fundamentals to agree. And first and foremost, the fundamentals must lead the way, in my opinion. And then you go back and you enter based on technicals once the fundamentals are there, not the other way around, right? You don't front run a change because at that point, then you're guessing. Okay, there's kind of my 2 cents in philosophy of trading, right? So I hope the Kiwi yen goes up, but we got to be careful. Is it possible that New Zealand comes out in the statement and says, caution, 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 caution. Scary, 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 scary. Or do you think they're going to come out guns a-blazing like, the world's a better place, you know, inflation is just crazy. We're going to have to jack up interest rates. Probably not, right? So just be careful because, the short-term rally in some of these commodity currencies had to do with a couple of things. Well, 3 things. And I hope, I hope it's good. I don't think it's going to be good, but let's just review last week, right? The oil market reversed on a key reversal area. 3 major stock markets reversed on a key reversal area. And at the same time, the world thinks Kuroda at the Bank of Japan is going to add to quantitative easing, and therefore the yen got super weak. Is that a basic summary of what happened in the last 72 hours of trading? I think there's a lot of hope in that. Okay? And my hope is that sometime this week, we confirm that it's true. Okay? But until it's confirmed, I'm going to call it fool's gold. So we got to be careful. Okay? We got to be careful, and we're going to learn a lot here, and if they could kill the Kiwi here. Okay? Because there's no, just give me 3 reasons why you believe the New Zealand dollar is going to go up at the end of the year, by the end of the year. Right? It's a pretty simple thing. And you say, oh, well, that's easy. China's going to just rally. Commodity currencies are going to, commodities are going to double, so on and so forth. And you're like, ooh, well, yeah, well, those are pretty hard, right? Oh, Damath says, well, the carry trade yield differential, right? All right, so over the last 2 years, has there been a positive yield differential? And the answer to that is yes. And over the last 2 years, has the New Zealand dollar gone up or gone down? See, this is the problem. This is why, studying at school is really fun, because they do this model and they're like, see, look, the New Zealand dollar should be strong. Well, then why has it fallen for 2 years straight? Harvard University, right? I actually failed on a midterm question. I didn't fail the midterm, but I got a question wrong, and I even challenged the professor after it, and they're like, nah, you're totally wrong because I'm the professor and you're just a stupid student, right? I got this one wrong where, oh yeah, gold and the US dollar, right? Gold is the anti-dollar, right? Right? Everybody knows that, right? It's common sense, right? If dollar goes down, gold goes up. Yeah, I got that one wrong. I'm like, what? It's the anti-dollar. No. What? What do I know, stupid trader? But, the interesting thing about, the academic modeling, let's say, and trading, I'm really actually fascinated in, because the models, or somebody said, right, all models are wrong, but some are useful. I think that's very good. I think when you sit down and think about the logic in a big macro view, it totally makes sense. But then there's shorter term, and short term for, an economist is years, maybe decades, right? So anyways, there's this interesting dichotomy of, you have the macro view. It makes sense, right? You're going to borrow cheap money. You're going to invest into high yield. That makes sense. But there's other things going on, right? And on the shorter term, there's other things that need to happen along that way. And I think, like some people want to create a unified theory of in physics, macro. What do they call it? Why is it not my brain? Mechanics, quantum mechanics, and quantum. Damn, man, my brain. I must be getting old. Quantum physics and quantum mechanics, I guess, the study of the very big and the very small, follow many of the same rules, but they don't jive. They disagree in part, but they should in theory, right? Because you have a nucleus and it's got a little electron floating around it, exactly like the Earth going around the sun. So you're like, wow, that's very similar. Galaxies and solar systems act a lot like the very, 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 very small, except sometimes it doesn't. And I think the analysis world and the academic world and those that build these models, and then those people that invest, those that trade, those that scalp, it doesn't quite add up, doesn't quite line up. And maybe that's why there's opportunity to make money, but I think it'd be interesting to build a theory where all that works together. But anyways, yeah, New Zealand right now, 2.5%, huge yield in our world, but that economy is crashing, and the value of their currency is also crashing. Very interesting, right? Okay, now one of the things we were talking about a bajillion years ago was that GDP out of the UK was going to come out red hot in the first quarter of 2016, right? We talked about this last summer. Okay, I'm going to caution you a little bit on this. Don't start walking around saying, well, Wayne said this and blah, blah, blah. This is preliminary, redonkulous, 90% chance of being wrong number. Okay? So if it does not come out red hot, it's not my fault. But if it does come out way better than expected, then I totally called it. All right. But it's preliminary stuff, and they do this for a reason because it's a complicated number to crunch. And I don't know if they're going to do it right. Okay? But do you understand that? Like, can I count on them to do it right? When they're coming out right off the bat saying, well, this number's probably going to be wrong, so we'll call it preliminary. Right? It's just sissy right off the bat. They're not even calling it GDP. Well, it's just sort of like preliminary. We're just going to kind of start the work and throw out a number, and then we're going to come back and revise it. All right, great. So if they're going to hedge, I need to hedge, right? But if it comes out 2.8, I totally called it, and I'm the greatest trader in the whole wide world. Okay, durable goods, fine. Some good scalps here if there's some spending, but look we're expecting 0.0. Wow, that's better than last month, 0.1. Okay. John, I don't want to talk about a possible recession at the moment because right now I still believe it's noise. And the last thing we need to do is start listening to other people. What we want is for us on our own to do our own analysis and make our own decisions. But there's so much when you start reading newspapers and watching TV and all these talking heads go on air telling you about it's the end of the world or it's the greatest opportunity for investing. They're talking their own book. And they also have to be sensational, otherwise they're not going to be interesting. Okay? So I just, and I'm not saying that's you, John, but I'm just saying as a group, let's stay away from that. Let's not even care. Let's look at the facts ourselves, right? And so, and we can try to review that later today, but I already did it last week where I showed you the line in the sand for the stock market 6 months before we even tested it. And then when we got down there, we hit it and we bounced, and that's cool. So if we stay above that line, I don't think there's even an issue. Okay? So that's my point of that's my thought, John. Don't even want to see it. I don't even want to talk about it until I will talk about it if we breach that area, because then I could say, wow, it's a long ways down, and then maybe this is something. But I don't think we're going to go in recession when we have quantitative easing out of Europe, and we expect more quantitative easing at the next meeting because that's what Draghi said. And if Draghi saves Europe, then Europe saves China, and then China saves everybody else, and we're fine. But we're at the very beginning of a 5-year path. Right? And what I said last year too, the stock market coming down is simply a rebalancing of long-term portfolios. And then people say, well, what about the stock market in China? That's the stock market in China is stupid. It's completely manipulated by the government. Why is that a leading indicator for anything? What does it have to do with anything? A mutual fund can't even get out of their trades. It's against the law. And then when they need to prop up the stock market, the government comes in and buys stocks. It's worthless. And money is flowing out as fast as they possibly can get it out of the country because of stuff like that. So, all right, now if the stock market was like this, the money market I was showing you here. Okay, this is truth and reality. Now the Fed can get involved. Okay, but I don't know. I guess they're all manipulated in different ways, but just this idea that a big investor can buy a stock, but then they can never take profit. It just, I mean, right off the bat, it makes the whole thing pointless. Right? Okay? It's just pointless. It doesn't mean anything because it doesn't show me what investors are really thinking. So, who cares? It's pointless. Oh, well, the U.S. stock market's going to fall because the Chinese... Come on, dude. Let's make some money. So anyways, durable goods, we're expecting nothing. And wouldn't that be nice? Isn't that funny? Nothing. Inflation out of Japan, this is an important one because Kuroda is saying that he's very confident, or no, not confident, optimistic that they're going to hit their goals. And so this is a measure of that. Okay, it's important enough where CPI comes out and then they're going to have a press conference. Lots of people believe Japan is going to do additional quantitative easing, right? That's why we had Kiwi yen take off last week. I don't think it would fix anything, do you? Okay, but this is a key area. So when you look at all this stuff, guys, this is a very important week fundamentally. Okay, GDP out of the U.S., GDP out of Canada, GDP out of the UK, right? Bank of Japan press conference, RBNZ statement, FOMC statement, big ones. So do you think these currencies are going to move this week? Should you watch CAD? Should you watch Pound? Should you watch Kiwi? And then what about New Zealand on Wednesday? Do you have an opinion? Should you start trading the opinion today? If you think they're going to come out and say bad things like nothing in our economy looks good right now, then maybe you find a logical, intelligent place to sell it, in which on a 15-minute and hourly chart, you feel very comfortable that you can get a decent trade, and over the course of a reasonable amount of time, you're going to be able to move your stop to break even. And then slowly, since you're in 2 days before, other people tomorrow might start doing the same, but you're already in at break even. So then tomorrow you make 75 pips on Kiwi. And then the news comes out 24 hours after that. Now you're very comfortable because you're up 75 pips, your stop's at break even. Okay, another 24 hours comes more, and then people on TV start talking about it, and it drives it down even more. And then the news comes out, pacham, bad stuff, and you've picked up 300 pips. Right? Or you could just wait until it happens, catch the retracement, maybe pick up 30 pips, and you'll be happy. Your call. Why don't you do both? So I'm just challenging you. Think about it in advance, come up with some sort of strategy, and carry it out. Wouldn't that be an interesting strategy to say, I'm going to front run what I believe is going to happen on Wednesday. I'm going to start the process on Monday. I'm going to sell at resistance, right? Get my stop at break even, and we'll see where we are on Thursday or Friday. Where are the pivot points going to play out technically? Could be very interesting, right? Okay. Which currency pair? Well, you could really get complicated here and say you don't believe the Bank of Japan is going to add to quantitative easing on Friday. What would that do to the Japanese yen, the value of the Japanese yen? If people think today, they think the Bank of Japan is going to increase quantitative easing, and then on a Friday we find out they're not going to increase quantitative easing, what happens to the value of the Japanese yen? Stronger. And maybe if that's your job, so now you're telling me on Monday you think there's going to be, a lack of good news out of New Zealand, so it deflates that hope. And then there's hope that the Japanese are going to do quantitative easing. Let's deflate that hope, and maybe next week, 1 week from now, you're up 500 pips on the Kiwi yen, because the Kiwi starts the week, by the middle of the week collapses, and then on Friday, Japanese yen skyrockets in value, dragging it down, and now you're actually making two plays on one trade. Future New Zealand dollar weakness and future Japanese yen strength. Now that's adding a layer of complexity, but if you get it right, it's more pips in your pocket. And you might be on that trade for 6 months if you want, but you're going to have to pay the negative yield. Your call. But isn't that what currency trading is, guys?